Welcome to our LATAMPaper December 25th. We wish you a wonderful Christmas and all the best for next year.
Global demand Q1-2026. Expect a soft landing baseline, growth slow but positive, with USA demand steady, Europe subdued but stabilizing, China mixed, solid in policy-backed sectors yet cautious in property-linked consumption. Inventory/supply chains are fragmented, manufacturing PMIs hover around the 50 line, while capex concentrates in AI, grid, and energy transition equipment. Expect continued USA, China/European Union, China measures, wider anti-circumvention/transshipment scrutiny, and more targeted anti-dumping duties in metals, chemicals, agro, and machinery. Compliance costs rise as rules of origin tests, data traceability, and carbon border schemes tighten. Some countries add reciprocal or safeguard actions, while emerging markets tweak import regimes for FX stability. Practical playbook for Q1-2026. Pre-clear HS classifications early, dual source across tariff blocks, right pass-through and repricing triggers into contracts, and stress test landed costs under +5 to 15% duty scenarios. Latin America enters Q1-2026 with consumption still flat to modestly positive, not roaring. Real wages have healed unevenly. Inflation is lower but not fully anchored, so households remain price-sensitive and trade down in discretionary baskets. Mexico and parts of Central America get a floor from remittances and formal employment, while Brazil's middle segment holds up on credit costs easing and targeted fiscal transfers. On exports and liquidity, the picture is tactical, not bleak. Energy, mining, and agro remain the backbone. Nearshoring keeps Mexico and a few Andean/Caribbean manufacturing nodes structurally investable. The rules of origin checks and tariff noise demand cleaner traceability. Financially, local curves continue to ease as regional central banks stay in late-cycle cutting mode, while a softer Fed backdrop trims dollar funding stress. Yet access is selective. Top credits fund comfortably. Weaker credits pay up.
Containerboard. Year-end looks very quiet. Since November, we have seen demand decelerating. In South America in particular, many players over-inventoried on high export expectations. We believe most peak season orders have already been booked, so there's little urgency to place additional volumes. Q1 appears stable with low expectation that prices will change. We have to see how second Q behaves. In recycled grades, we're seeing less aggressive pricing/positioning from European mills, coupled with sluggish demand for industrial corrugated boxes. Pulp, we're seeing upward price pressure in hardwood pulp, especially eucalyptus. Post-London, the market believes there is room for increases. For now, a $20 per ton hike is settled in most markets. That said, global demand remains sluggish, making 2026 difficult to forecast. By contrast, softwood pulp remains under strong downward pressure due to weak demand and ongoing substitution by short fiber grades.
Thank you for watching. See you soon.